What if the 2008 financial crisis could have been stopped? What if a machine had seen it coming months in advance? It sounds like science fiction, but deep inside the world's most powerful financial firms, a new kind of intelligence is waking up. An AI designed to spot the hidden patterns that lead to economic disaster. We went to the experts to ask, could this be the key to preventing the next global financial crisis, or could it be the very thing that causes it? On Wall Street and in the massive data centers that power our economy, a ghost is waking up. It's not a single program you can point to on a screen. It's an emerging force, a new brain being woven right into the fabric of modern finance. This brain is artificial, and its main job is to do something humanity has dreamed of and failed at for centuries: predict the future. Hedge funds, investment banks, and even central banks are now using AI to sift through mountains of data at speeds no human could ever match. And these systems drink from a fire hose of information every single day. They don't just read financial reports or watch stock tickers, they analyze satellite images of shipping ports to measure global trade, they scan social media and news articles to gauge public mood in real time, they track credit card sales, supply chain hiccups, and even the tone of a CEO's voice on an earnings call. This AI is a digital detective that never sleeps and never forgets, piecing together a trillion-piece puzzle to answer the $10 trillion question: what happens next? For the giants of finance like JP Morgan Chase, AI is already a vital tool for everything from spotting fraud to handling customer service. They've even used AI to analyze 25 years of speeches from the Federal Reserve, hunting for hidden clues that might give them an edge. Specialized hedge funds have gone even further. A new breed of AI pure play funds has emerged with names like Numerai that bet their entire strategy on algorithms. They're betting that pure code can outperform human gut feelings. The Eureka Hedge AI Hedge Fund Index, which tracks these firms, has shown periods of outperformance against its human run counterparts, signaling a real shift in the balance of power. This ghost in the machine isn't just another gadget, it's a fundamental change to the game. For decades, finance has been a human story of fear, greed, and intellect. Now, a new player is on the field. It feels no fear, it has no greed, it only has data and a relentless drive to find the pattern in the noise. The promise is incredible: an early warning system for the financial tsunamis that have wiped out fortunes and ruined lives. But as we build this all seeing oracle, we have to ask a critical question. Just because it can see what's coming, does that mean we can stop it? To understand why that promise is so powerful, you have to remember the pain. You have to remember what it feels like when the system breaks. For millions of people, 2008 isn't just a year, it's a scar. That was the year the global financial system, something we all thought was solid, turned out to be a house of cards. The whole thing was triggered by ridiculously risky loans and financial products so complex that almost nobody, including the people selling them, truly understood them. Banks had basically ignored their own rules, handing out loans to people with bad credit, which led to a tidal wave of defaults that crashed the entire global economy. The fallout was a catastrophe. It wasn't just numbers on a screen. It was families losing their homes. It was parents watching a lifetime of retirement savings evaporate in a few weeks. It was college grads stepping into a job market that had simply vanished. The crisis showed just how dangerously connected our financial world is and how quickly one fire can burn down the whole neighborhood. And 2008 wasn't a one off. Think back to the dot-com bubble at the turn of the millennium. A wild frenzy of speculation around new internet companies, many with zero profits or even a real business plan, pushed the market to insane heights. When that bubble burst, it vaporized about $5 trillion in market value. Investors who had bet their futures on the new digital age were left with less than nothing. These events were born from a toxic cocktail of human emotion, bad models, and a collective failure to see the big picture. For all their expertise, analysts and regulators just missed the flashing red lights. They were drowning in data they couldn't process and blinded by the herd mentality that's just part of our DNA. The market has always been swayed by sudden shifts in human psychology, things that are notoriously hard to predict. This is the wound that AI proponents want to heal. They look at the wreckage of the past and see a failure of human perception. They believe a machine, free from emotion and able to see everything at once, can spot the cracks in the foundation before the whole building starts to shake. The basic argument for an AI crash predictor is simple: we're human and we're flawed. We're brilliant and creative, sure, but when it comes to making sense of the vast, chaotic system of the global economy, we are hopelessly outmatched. Our brains are hardwired with cognitive biases. There's herd mentality, that little voice that says, everyone else is doing it, so it must be fine. There's confirmation bias, where we hunt for proof that we're right and ignore everything that suggests we're wrong. And then there's just simple information overload. More financial and economic data is generated every day than a whole army of analysts could review in a lifetime. This is where the machine shines. And AI doesn't get swept up in the hype. It doesn't have a gut feeling that some stock is a winner. It runs on pure, cold logic and statistics. By digging through terabytes of data, AI can spot the tiny, almost invisible connections that we would never see. It can see a subtle shift in online sentiment and connect it to a tiny jump in trading volatility. It can scan the language in thousands of corporate reports to find phrases that historically show up right before a company misses its earnings targets. This is already happening. Banks and asset managers are using AI to run complex stress tests, simulating thousands of nightmare scenarios to see how their investments would hold up. This lets them find their weak spots and adjust their strategy long before a real crisis hits. And they aren't just looking at the past, they're using generative AI to imagine future crises that haven't even happened yet, helping them strategize against the unknown. The dream is to scale this up from protecting one bank to protecting the whole system. Imagine an AI that acts as a central nervous system for the global economy, one that could monitor the health of every major institution, track capital flowing around the world, and spot systemic risks as they build. It could, in theory, ping regulators about dangerous levels of debt in one sector, or warn that a few seemingly unrelated events in different countries are starting to look like the perfect storm. It would be the ultimate early warning system, an all-seeing eye built not to replace us, but to give us a level of insight we never thought possible. So how does a machine actually learn to see a crisis coming? It's not a crystal ball. It's all about sophisticated pattern recognition, powered by machine learning. Think of it like this. You can teach a computer to recognize a cat by showing it thousands of pictures of cats. Eventually, it just learns the key features: whiskers, pointy ears, a tail, and can spot a cat in a photo it's never seen. An AI for market prediction works on the same principle, just on a ridiculously complex scale. Instead of cat pictures, it's fed decades of historical market data. Every stock price wiggle, every interest rate change, every commodity trade, it all goes in. But it also consumes unstructured data like news articles and social media posts, using natural language processing to understand the meaning and mood behind the words. The AI then hunts for correlations, for the faint ghost-like patterns in the data that came before market downturns in the past. It might learn that a specific combo of rising oil prices, certain keywords in central bank reports, and a dip in shipping traffic has, with a 70% probability, been followed by a market correction within 3 months. These are connections far too complex for any human to ever spot. To make these connections, these systems often use neural networks, which are algorithms loosely designed to mimic the human brain. They are incredibly good at finding complex, non-linear relationships in the data. This is what makes them so powerful. A traditional economic model is like a roadmap. It shows you the main highways, but it can't tell you about the massive traffic jam forming up ahead. An AI model is more like having a live satellite feed of every road on the planet, combined with real-time traffic data and the ability to predict a jam before the first car even hits its brakes. Some firms are already using these techniques with great success. Legendary quantitative funds like Renaissance Technologies have built their empires on complex mathematical models, and while they are famously secretive, it's widely believed they use advanced machine learning. Other platforms like Insight AI use predictive analytics to forecast market trends and asset prices, giving them an edge where information is everything. For example, an AI might detect a surge of negative tweets about a company and cross-reference it with data showing that top executives have been selling off stock. To a human, those are two separate facts. To an AI, they're a combined signal that could mean the stock is about to tank. By doing this kind of analysis at a massive scale, these firms aim to make decisions that are not just faster, but fundamentally smarter than their human competition. The proponents of this technology, the prophets of the AI-driven market, believe we're on the verge of a new era of financial stability. They argue that AI's data crunching power isn't just a small step forward, it's a paradigm shift. For them, the question isn't if AI can predict a crash, but how much warning it will give us. Firms at the forefront, like Reflexivity, are building platforms that combine huge data sets with explainable AI to find critical insights for investors. Their CEO, John Silagi, is so confident that, in his view, AI tools will eventually replace human financial advisors entirely. He envisions a world where automated, data-driven solutions provide better guidance, free from human error. These systems use autonomous AI agents to generate investment research and discover hidden links between companies and market trends. The logic is pretty tempting. Some AI models were already flagging a downturn in the early days of the COVID-19 pandemic by analyzing things like weekly jobless claims and mobility data from smartphones long before official economic reports came out. This allowed for a much faster response. Researchers from the University of Liechtenstein have developed an AI method to detect banking crises, and their early results suggest it can significantly boost prediction accuracy compared to older strategies. The World Economic Forum agrees, noting that advanced algorithms can spot complex anomalies that traditional methods miss, providing the early warnings needed to keep the system stable. Hedge funds are pouring billions into this tech. They're using AI for predictive analytics to forecast supply and demand, manage risk in real time, and fine tune their portfolios with a level of precision that used to be science fiction. They believe that by constantly learning, these AI systems can stay agile, averting huge losses by getting out of the way before a downturn hits. The prophets see a future where AI is a vigilant guardian, watching over the markets and protecting us from our own worst instincts. But for every prophet, there's a Cassandra, a voice warning of dangers we can't yet see. Critics argue that trusting AI to prevent the next crash isn't just naive, it's a recipe for a new and possibly worse kind of disaster. First is the black swan problem, a term from author Nassim Nicholas Taleb. A black swan is an event that's impossible to predict because it's completely outside our past experience. AI learns from historical data. It's great at spotting patterns that have happened before, but the biggest crashes are often triggered by something that has never happened before. No AI trained on data before 2001 could have predicted 9/11, and no model trained before 2020 could have foreseen a global pandemic shutting down the world economy. AI might get great at predicting the weather, but it can't predict the asteroid. Second is the danger of reflexivity, or the snake eating its own tail. Markets don't just reflect reality, they create it. If a powerful, widely used AI model predicts a crash and tells everyone to sell, that mass sell off could be the very thing that causes the crash. Now imagine thousands of competing AIs all reacting to the same data and to each other's actions in microseconds. You could get a monoculture where all the algorithms think alike and rush for the exit at the same time, triggering devastating flash crashes where markets nosedive in minutes. In simulations, AI agents have even learned to secretly collude with each other to fix prices without any human telling them to. Finally, there's the black box problem. Many of the most powerful AIs are completely opaque. We can see the data that goes in and the answer that comes out, but we have no idea how it made the decision. US Treasury Secretary Janet Yellen has warned that this very complexity is a significant risk to the financial system. The Financial Stability Oversight Council even labeled AI an emerging vulnerability for this exact reason. Can we really hand over the keys to our economy to an algorithm we don't understand? If an AI causes a panic, who's to blame? The programmer? The person who used it? The machine itself? The Cassandras warn that in our rush to build an all-knowing oracle, we might be creating a god we can neither understand nor control. So, where does that leave us? The truth, as it usually does, lies somewhere in the messy middle. The idea of a perfect crystal ball that can see the future is almost certainly a myth. The market isn't a physics problem to be solved, it's a chaotic system driven as much by human psychology as by numbers. AI won't eliminate risk and it won't make crashes a thing of the past. But dismissing the technology would be just as foolish. AI is a classic double-edged sword. On one side, its speed and complexity could make crises happen faster and hit harder. If everyone starts using the same AI models, it could create dangerous herd behavior, where one small glitch triggers a catastrophic domino effect. But the other edge of the sword is its incredible power as a tool. While AI might not predict a true black swan, research consistently shows that AI models can have superior predictive accuracy for certain tasks compared to traditional methods, especially with complex data. It can give us a real-time, high-definition picture of the financial system's health, helping regulators spot bubbles before they get big enough to pop. This technology is also having another interesting effect. AI-powered robo-advisors are making personalized financial advice and low-cost investing available to millions of people who were previously locked out. But while this opens the door for many, the most powerful predictive AIs are still kept under lock and key at elite hedge funds and big banks. This could end up widening the gap between Wall Street's insiders and everyone else rather than democratizing finance. The verdict? AI is not a magic bullet. It's a transformative tool, but one that comes with its own profound risks. We are trading the slow, biased analysis of humans for the fast, powerful, but opaque and potentially fragile analysis of machines. Maybe we've been asking the wrong question all along. Focusing on prediction makes AI sound like a mystical oracle, but the real revolution here may not be about prediction, but about understanding. AI's greatest gift might be its ability to give us an unprecedented, real time, high res picture of the present. Think of it this way: you can't predict the exact time and date of the next big earthquake, but you can install a global network of seismic sensors to map the fault lines, measure stress in real time, and scream a warning the second the ground starts to shake. That's the emerging role of AI. It's becoming a global sensing network for our economy. Central banks are already using it for nowcasting, getting real time reads on things like GDP and inflation instead of waiting months for official numbers. By analyzing everything from satellite images of factories to consumer spending, AI gives them a much clearer, more immediate picture of what's happening right now, allowing them to make faster, smarter policy decisions. This new level of clarity could be huge for stability. The International Monetary Fund has noted that as cyber attacks and market manipulation get more complex, regulators will need to fight fire with fire by using AI to spot fraud and other troubles. By automating this oversight, AI can help build a more resilient and transparent system, one where we deal with risks proactively, not after a crisis has already blown up. Generative AI takes this even further. Economists can run millions of simulations to see how different policies might play out, helping them prepare for many possible futures instead of trying to guess just one. The real value of AI may not be in giving us a single answer, but in giving us the tools to ask much better questions. In this future of machine driven finance, it's easy to imagine people becoming obsolete. But that vision misses the most important piece of the puzzle. For all its power, AI lacks one fundamental thing: judgment. It has no common sense, no ethical compass, and no clue about the human consequences of its decisions. That's why the most effective model for the foreseeable future will be a partnership, the human in the loop. Time and again, surveys show that most people want AI to assist human advisors, not replace them. Experts agree that human oversight is essential for legal, ethical, and simple risk management reasons. An AI can spot a statistical probability, but it takes a human to put that information in context, weigh the risks that can't be measured, and make a final value based call. The AI can be the lookout in the crow's nest, scanning the horizon with a superhuman telescope and shouting, "Iceberg ahead," but the captain on the bridge still has to decide how to steer the ship. This partnership uses the best of both worlds: the machine's speed and power, and the human's experience, intuition, and moral compass. This is critical for solving the black box problem. As long as these AIs are opaque, we need human experts who can check their work, question their conclusions, and hit the brakes when they seem to be going off the rails. We need to invest not just in technology, but in people with the skills to manage these powerful new tools responsibly. Ultimately, our financial future won't be shaped by machines alone. It will be shaped by the choices we make. The rise of AI doesn't remove human responsibility, it makes it more important than ever. We're building the most powerful financial tools in history. The burden is on us to make sure they're used to build a better world, not to engineer a faster collapse. So, where does this all leave us? We're at a crossroads where AI and finance are merging to create a new reality, one filled with both incredible promise and serious peril. The dream of an AI that can stop the next financial crisis might stay a dream, but the journey toward it is already changing our world. AI may never be a perfect prophet, but it is proving to be a powerful mirror, reflecting the complexity, fragility, and hidden patterns of our own behavior right back at us. It's giving us the tools to see ourselves and our system with brand new eyes. The real question isn't whether a machine can predict the next crash. It's what we'll do when it tells us one is coming. What do you think? Can we trust an AI with our economy? Let us know in the comments. And if you want to keep exploring how technology is reshaping our world, make sure to subscribe.